I'm Gina Szymanski. I'm a portfolio manager and managing director here at AEW. AEW is one of the largest real estate managers in the United States and globally. And I work on the public security side, responsible for the North America REIT portfolios. So a few things. Number one, I would expect more volatility. The REIT space has been volatile already, but until the markets really get more clarity around Fed increases, when the Fed decides that they'll pivot back to an easing stance, how much impact they'll have on business and consumer credit as they really try to combat this inflation. I would expect, much more volatility in the months to come. In terms of earnings outlook, we do expect slowing growth in the back half, just because we have some tough comparisons year over year, and a lot of the companies still have yet to incorporate the impact of higher rates. But that said, I would say in the next several months, I think investors will be surprised to learn that 2023 is going to shape up as strong as it can for the REIT space. So we have our universe has a 3.5% dividend yield. The payout ratios are in the in the high 60s. I would say that cash flows for next year are going to be, as we estimate them, in the high single digits. And again, I think investors would be surprised to learn that is pretty on par with the S&P 500. We're trading at similar multiples to the S&P 500, but I think our earnings, the earnings cash flows and outlook for REITs is much more resilient relative to what I understand to be potentially a downward bias to earnings expectations for the S&P 500. So I think it's a decent setup for REITs here. It's definitely created a headwind. The stocks are down about 17% year to date. They were down more. More recently, they've had a little bit of a rally recently, but again, year to date, down 17%. So we actually think the public markets have overshot, so long as the 10-year stays in the 3% range. The companies themselves, so that's the stocks. The companies themselves, I would say what the managements are doing are really trying to avoid the public markets. So doing everything they can not to have to raise equity or debt at these high coupons and dilutive prices. So what you see a lot of managements doing is slowing their pace of acquisitions, kind of pencils down and seeing how cap rates shake out in the private markets, and then also a lot of capital recycling. So if a company is really heavy in terms of development activity, instead of raising equity to fund that development, they'll sell some current assets and take advantage of low private market cap rates to fund that development. So, I mean, I think it's well known, or it should be well known, that real estate is definitely, it's a hard asset and tends to pass through a lot of benefits of inflation. So, what we've noticed and observed in our space is the strong pricing. So, anywhere from the property types that tend to be more net leasy, not really growing more than low single digits in a given year, those growth rates are biased higher. Spaces like hyperscale data centers, medical office, even places where they're net lease, but maybe even have benefit of inflation linked escalators, like gaming assets, some towers, especially on the international side. So we're seeing that the benefit there. And then a more pronounced benefit you're seeing in residential. So apartments, single family rental, we're seeing 10 to 15% price increases. Storage, self-storage, anywhere from 20 to 50% price increases. Industrial, probably call it 10 to 20% price increases. Hotels, as we all know, shut down during COVID. A lot of people were, prevented from traveling for a couple of years. The room rates are, 20+% above pre-COVID at this point, and occupancies haven't even rebounded. I mean, they've rebounded off the trough, but they're still not back to pre-COVID levels. So very strong pricing trends, pretty much across our group. I liked this question a lot. I was thinking about what we're seeing in terms of emerging trends, and I think my answer would lean towards the topic of ESG. So ESG has been a pretty big trend in recent years, how the buildings are managed. But what I think is interesting is, ESG used to take the form of pretty simplistic improvements to, electricity efficiency, and do you incorporate LED lighting and that type of thing. But now it's ESG is getting very political, and so everything from does your cafeteria offer smaller portions of soda cans so that you're not imposing higher calorie counts on your employees? Do your spaces offer transgender bathrooms? So a lot of these types of things are starting to be important criteria that landlords and tenants have to think about. And I guess I would also mention, why is this happening? Why is this happening? I think it's because the younger people coming into the workforce really care about social impact, and so the landlords have no choice. And the companies that these people are working for have no choice but to listen and act in a socially responsible way. So I think that's a really big emerging trend. So I think some of the most favorable sectors will be the sectors that have the best growth outlooks. We're still very positive on industrial as well as residential. Industrial companies, have been hit recently just because of Amazon's comments about overshooting in terms of their space needs on the warehouse distribution side, but that space is being absorbed by strengths in many other areas of the economy, and so what we're seeing are very tight vacancy rates for industrial across the U.S. and across the globe, for that matter. We're still seeing really strong price increases on top of the last several years also being very strong price increases. And so one of the metrics that we look at is called loss to lease. That's really just a measure of portfolio rents relative to asking rents in the market. And we see our companies having loss to leases anywhere from 40 to 60%, meaning, even if the Fed's successful in slowing the economy, even if we go into a mild recession, there's really strong earnings visibility within the industrial sector just because of that significant loss to lease. And then another area I would point out is residential. Both traditional apartments as well as some of these niche areas like manufactured housing and single family rental. All of those should see pretty strong demand in the next couple of years, especially. I mean, things were good before, but now you have an unprecedented rise in mortgage rates. So before, you get a quote for a mortgage rate, sub 3, and now it's over 5. And so whatever you expected to pay for a mortgage has pretty much doubled. So that's going to, make it hard for a lot of, people who had home buying plans to, we might have to rethink and maybe stay in rental properties a little bit longer in order to be able to afford that house. So we think that is a benefit to that sector as well.